So let's get in Rahul Singh, Head of Equity Research at Standard Chartered Securities, to talk about that. Hi Rahul, good morning. It is expected to be a very good morning of trade, but how are you positioning yourself now, given that a lot of it has already played out, between August and now?
Yeah, I think you're right. A lot of it had played out, but I think the results are still, though short of unequivocal kind of a view, is still a positive. The way I see it, I think. The way to play it is to remain rational and remain grounded at the same time, which is difficult. So how do we do that? I think one has to focus on sectors where we had already seen some progress and reforms, and focus on those sectors and build exposure in those sectors, rather than running after everything and anything. So I think there are two sectors where we are very bullish on, even before the election results, and I think the election results merely adds to that. Is the oil PSUs and the power sector, and both these sectors actually, if you see, have not bounced back very hard from their respective bottoms. And in both these sectors, we have seen reforms happening, but the market has obviously not paid enough attention to it. In oil and gas, we have seen, gas price hike is to be notified shortly. Diesel price hikes have been happening, but the valuations are still lower than what they were in January. So I think that is one sector which can benefit immensely from a strong government at the center sometime later this next year, even as the current improvement continues under the current government. In the power space, again, similar story. We have seen things falling in place, but as a package, market has not acknowledged it enough. We recently upgraded Tata Power, and that remains our top pick in the sector. We also have BHEL in our portfolio. So I think instead of running after PSU banks, where I think, one, the bounce back has been hard and there are still a lot of issues to get sorted out, we would play it through oil PSUs and power sector.
Okay. Hi Rahul, good morning and good to have you on a big day for the markets. What do you think will be the tenor of the market? Will the pie itself grow in that, the Nifty itself goes to 6,800 or 7,000 as some people say, and therefore there is more for all stocks to rise? Or will the rise be more tepid, and so you will actually see money getting taken off from the IT and the pharmas? Incidentally, rupees 60, 90, 60, 88.
I think it will be more of the latter, which is rotation will be huge. So I think if you look at the Nifty per se, it may not rise that much, because you have got high weightage stocks like ITC, Infosys, to some extent Reliance. They may not gain that much as the rest of the market might gain, and therefore the rise in Nifty, I'm not expecting it to go anywhere close to 7,000 in a hurry, but I think the rotation will be the name of the game, because you have to remember that last 2 to 3 years there has been a huge lack of alternative theme which has been playing out, and that has only started unwinding about 6 months back. So that has just started. So I think you will see rotation from the defensive sectors, which even could include sectors like telecom, pharma, consumers, IT, into some of these names which I mentioned about earlier.
Okay. You just mentioned that it is better to remain rational and grounded at this point in time, and that the Nifty may not, surge to higher levels. Why is that?
Because of the rotation, as I mentioned, because if you look at last 4 years, it's not that we have not got FII inflows. We've got fairly chunky FII inflows which has gone into particular pockets of the market, and depending upon how taper goes from here on, what you will see is a mix of rotation and new money coming in. So therefore, if you look at the large index weights today, which is the likes of ITC and some tech stocks, they may not lead to, they might constrain the rise in Nifty with the same pace as you might see the rise in, say, the power stocks or the industrial stocks or even bank X to that extent.
Rahul, when we speak of individual stocks, changes in governance often lead them to become multi-baggers. You don't think India will be treated as a turnaround script, actually, at least up until May, before a new government is formed?
That's a nice way to look at it, but within the index, if you look at really and we had done this analysis, about 35-40% of the index, of the indices, comprise stocks which are anyway perceived to be very high corporate governance, low leverage. So I don't think you will see the same delta in that part of the index. So what we are talking about is actually the remaining 50-60% of the index, and even within that you will have issues of fundamentals being not so great in some sectors, despite what we might have as a strong government. So to generalize and say India as a turnaround script in that sense will be probably stretching it a bit.
Okay. Well, do you, I mean, I was expecting you to say that you foresee other negatives, and for me that big one is whether the lame duck government gets into a freebie mode. Do you fear some slip between the cup and the lip in the intervening months? What kind of a bottom would you look for this market, therefore?
I mean, there is obviously a risk in getting into elections, but we have been living with that risk, and I think this government, to be fair, has made certain progress in, especially in, let's say, oil and gas sector, which I was mentioning to you about. I mean, who would have thought that they would raise diesel prices just 4 days before Delhi goes to elections? So let's be fair to what this government has actually stuck to, and I think to say that they will go back to hugely populist kind of measures over the next 5 to 6 months. There is always a risk, but that risk is with any government, with any elections. I don't see any signs of that as yet to be really worried about it.
Okay. We still have about 2 more minutes to go, so let me try and squeeze in one more question, Rahul. On a valuation parameter, how are you assessing this market now? Because we're still about 15% below our 10-15-year average. At 12 times, do you think that this market on a valuation parameter deserves a re-rating?
Well, I'm not sure how you're getting that 12 times. I mean, on our estimates for Sensex, it's trading at 14 odd times 1 year forward. So it's around about at the mean. I think given the expectation about the turnaround in certain sectors and especially capex cycle and some of these stranded assets and reforms, one can expect a 5 to 10% kind of overshoot of this mean, even when the earnings don't get upgraded. I mean, for all of this, we know that earnings are not going to change in the next 3 to 6 months. Most of the earnings are going to be flat. So what we are talking about is only a multiple expansion, in which case a 5 to 10% kind of an expansion is the best possible scenario in my view for the overall market as a whole. But again, as I said, some sectors will do much better than the other sectors which have benefited in the last 2 to 3 years because there was no alternative.
Okay, we have a minute to go for the markets to open, Rahul, so you must forgive me if I cut you off when you are answering. But do you think the mid-caps will do better than the small cap, than the large caps?
Well, there is a logic for that to happen because some of the mid caps have got obviously hit because there was too much focus on large caps, and especially in large caps, as people run out of ideas and options, you could see some of that. But it all depends on how long this rally continues and what happens in the taper scenario and so on.